Hello and welcome to the HOA Show, where we discuss the news, problems, trends, and critical issues relating to life in a homeowner association. Join us every episode, and together we'll explore how to survive and thrive in the dizzying world of HOAs.
Hello, and welcome to the HOA Show. I'm your host, Ryan Gazelle, and in this episode, we'll be discussing insurance claims and best practices for navigating them, paying particular attention to the wildfire insurance losses that we've seen this year. I'm joined today by Jesse Rubin and Tony Menke. Jesse Rubin is the president of Rubin Adjusting, one of the leading public adjusting firms in Southern California. Jesse was steeped in public adjusting from a young age, working alongside his father since 2013. He specializes in structural repair estimating, personal property inventory and valuation, as well as business interruption analysis, calculation, and negotiation. He currently serves on the board of directors for the Pacific Coast Association of Public Insurance Adjusters, also known as PCA-PIA. PCA-PIA, we'll go with that. And we have Tony Menke, who has actually been a guest expert on our podcast before, where we talk about tendering claims to the insurance carrier. So we're glad to have you back, Tony. Tony is an associate vice president of the client agency and holds designation as a chartered property casualty underwriter, the CPCU designation. Having worn many different hats since joining our team, Tony has become the primary claims coordinator, striving to make the complex jargon of insurance coverage and finance more accessible to the client agency's clients. Thank you both for joining us today, guys.
Thanks for having us.
Yeah, thank you.
So Jesse, tell us, how did you get started as a claims adjuster? What drew you to this thankless line of work?
Well, my father's been a public insurance adjuster since 1972, and I grew up going to all of our events. We're very involved in the national organization as well as the Pacific Coast Association. So for me, insurance claims have been what we talked about around dinner. It's what we always knew about. So when I graduated from high school, I decided that the best course for me was to work with my father and to learn from him. So I took that time to apprentice underneath him. And after around 4 or 5 years, the apprenticeship ended, and I was able to move forward as my own adjuster.
Daddy, tell me a bedtime story. Once upon a time, some water was left on by an unsuspecting unit owner. I love it. I love it. All right. So Jesse, can you explain to us, adjusters are often misunderstood or underutilized. From your perspective, what is the role of a claims adjuster, both from the carrier side as well as the independent side of things?
Of course. So there's 3 different types of adjusters in California. There are staff adjusters, independent adjusters, and public insurance adjusters. So staff adjusters are employees of the carrier themselves. It's a State Farm employee who's being paid a salary, and their performance dictates the bonus that they receive. Independent adjusters are contracted for a project basis. They're normally paid at an hourly rate. They bill through their firm, who is the one that's interacting directly with the carrier. Independent adjusters normally operate as field adjusters. They're eyes and ears. They're giving the insurance company details of what's occurring, but not always making decisions on claim payment and coverage determination. Public insurance adjusters are very different. We're licensed by the Department of Insurance to advocate for property owners, be it HOAs, unit owners, or owners of single-family dwellings or businesses. We are trained to both quantify a claim and to negotiate that claim in a wholesome way with the insurance company so that everyone has a result that's equitable and fair at the end of the process. So we play a very key role of taking the property owner's needs, translating them to the insurance language, and then convincing the carrier that it's in their best interest and the property owner's best interest to settle in this manner.
That makes sense. Tony, could you, maybe just walk us through a typical insurance claim process from the initial loss to the final settlement? What happens in order typically?
So when you're looking at a claim in an HOA, specifically, you're going to, for example, like a water loss claim, there'd be the occurrence. The owner would reach out to their management company if they have one, or contact their insurance agent or broker directly. That broker would then notify the insurance carrier, who would assign. Most commercial insurance policies operate, as Jesse said, with an independent adjuster because they don't have a local presence. So they're going to hire that independent contractor to be the boots on the ground, so to speak, to then investigate, gather the data about that claim, prepare a report and coverage recommendation that goes back to the carrier for final review. In a perfect world, it kind of works very smoothly, step by step in that fashion. But if there are disputes or disagreements regarding the valuation of the claim, the nature of the loss, the process can be hung up a little bit. Or if the disputes or disagreements sometimes can't be resolved, that would be when someone like Jesse might step in to advocate for the individual owner to the insurance carrier. Kind of covers the gamut because in a cut and dried claim, so to speak, if there is such a thing, the carrier comes out, evaluates the loss, there's no disagreement about the value, and then everyone gets a check and goes about their business. But it doesn't always work that way.
Yeah, we're in the unique circumstance where, sometimes our boards want the carrier to pay out as much as they can, and other times they don't want them to pay out anything.
Yeah, it's a slippery slope in both directions.
Yes. So before we get into some more specifics on, the wildfires and some of those issues, how important would you say it is to both of you, I guess, documentation? What should homeowners and associations, property managers be keeping track of before and after a loss that would make any kind of a claim easier to adjust?
Go ahead, Jesse. That's right up your alley.
Yeah. So one of the things we've been talking about right now, and it comes up very often with our HOA clients, is some form of a conditions report on the property itself. One of the most common arguments that we have from carriers was that something was in poor condition prior to the event, and that the event described, whether it's a water loss or seismic shifting or smoke of some sort, did not have a part to play in the damage at hand. If we were to have some level of documentation prior to that, that would show, no, it was in good condition, or in fact, maybe it was not in good condition. That would help to know what truly should be involved in the claim and what should not.
And what does that kind of documentation look like successfully that you've seen? Is it a valuation with pictures by a professional valuation company? Is it somebody walking around like the manager or the board president with their cell phone taking video of everything?
It really depends on the level of involvement that someone wants to have. There are companies like my own where for past clients where they've seen we've been able to add value in the past, they'll have us come out, fully document the site so that if they were to have a claim in the future, they have some sort of documentation to pull back to. And it could really vary. Some people will take Matterport scans so you can really see the way that the rooms were. Others will just do photos in some form of an Excel spreadsheet. The question of dollar values is not always exactly what we're keyed into. It's rather what condition is the property in and how would that be expressed later if there were some form of event.
What was that term you used? MAD something?
Matterport. So that's like a 3D spatial scanning technology. There's applications that phones can do it as well, but that's a standalone unit that does this type of image capturing. You've probably seen them on Zillow and Redfin, where you're able to walk through a property and see exactly how it was. Something of that nature would be valuable, but is not always feasible depending on the size of a property. So it's really not a one-size-fits-all solution. It may be the property manager that performs this, or it could be a company of like mine, like a public insurance adjusting company. It may also be a very comprehensive contractor. That could be another component, but having some level of detail here would make our job in the claims adjustment much simpler.
So Jesse, how often do you think would be practical for an entity to exercise that sort of thing, to have that record?
It's a hard question. It really depends on the exposure of the property. If the property is known to have events very often, it may make sense to do it more often. Whereas if it has not had something in a very long time, maybe once every few years. I think also that construction changes in the property should trigger something of this nature so that it's recorded effectively and you have that there to show, yes, this is how it was on this date.
Now that brings up the question, what are some of the most common mistakes that you see homeowners associations or unit owners make during this claims process?
So a big part is whenever something like this happens, the homeowners associations and the unit owners need to have clear communication and work well together. I have seen many of these relationships deteriorate where there's a lot of distrust because the HOA is not necessarily conveying what needs to occur effectively to the unit owners. This is a very vulnerable time for everyone that's involved. If you're a unit owner in a wildfire type event, you're out of your home. That's devastating. If you're an HOA member in a wildfire event, you now have a huge responsibility placed upon you that you may not be ready to take over. Communication is key, and asking for help, knowing the type of help that you need, and getting help like what you guys can provide with your insurance broker, perhaps having some level of legal guidance. There may be some level of accounting that needs to get looked into. And if the claim has questions, finding someone like myself that can give an opinion on how to proceed with that can be crucial.
Yeah, to piggyback on that, speaking specifically about maintenance issues or plumbing issues leading to water damage, the biggest thing I see is the confusion of property and liability exposures on the part of the insureds. In this insurance market, a lot of people are very reluctant to file claims. They don't want to have their premiums go up. So they sort of take on this gatekeeper or goalie mentality of, wait, it can't get through us. We have to make sure this is worth filing. And it becomes a sort of analysis from, an amateur point of view of, well, this owner maintains this piece of plumbing, and so it damaged 5 units. So that's the owner's issue. They've got to take care of that on their own, which is not how the HOA insurance perspective sees that event. So it's really important if there is a loss to talk with, as Jesse said, if you have regular contact with the public adjuster or with your broker or with anyone who you trust to give you guidance in those situations. Hopefully it's an insurance professional, but just someone to sort of lay the groundwork, because unfortunately insurance doesn't always work in this sort of linear, common sense kind of way that we anticipate that it might. Just because a piece of plumbing failed that's maintained by an owner doesn't automatically make that owner liable for all that damage. There's a lot of intricacies and nuances between the owner's insurance policy and the HOA policy that have to be taken into account.
I've heard you say before, and I repeat it frequently, that a property claim is finite and a liability claim is not. And if you prevent that unit owner from coverage that is collectible on the master policy, that property claim just became a liability claim, right?
That's exactly right. And a property claim is much more simple than a liability claim. A property claim is essentially tasked with 3 questions. First question is this damage the result of a covered loss? Second question is, okay, do we have covered property damaged in this loss? And the third question is, what's the value of that covered property? That's it. That's the composure of a property claim is right there.
They don't care about fault?
No. In an HOA, it's very difficult to establish fault because the Fannie Mae and Freddie Mac lending guidelines prevent subrogation against an individual unit owner. So even if someone is negligent inside that HOA causing this damage, the HOA master policy obligation doesn't change. They're still the primary coverage, again, as required by Fannie Mae and Freddie Mac. So they're going to have an obligation to have that reviewed from the master policy perspective. And it's also going to prevent that master policy from subrogating or pursuing an individual unit owner for their individual negligence. So fault doesn't really weigh in as much as what's been damaged and what caused the loss, not whose fault it is. And, to sort of counterpoint that, the property claim is focused on those 3 points. A liability claim can be focused on anything from those 3 points and on to any related expenses, inconveniences, perceived expenses, perceived emotional damages, and so on and so forth, as well as the attorney's cost to argue those cases. So it's a much more complex and much more cumbersome undertaking.
You can't put a price on feelings.
Well, people try, and they usually value them very high.
One thing I'd love to add to that too, and it adds a little layer of complexity. So with water damage claims, that generally insurance policies have very strict exclusions for water damage. But the policies normally do not cover water. But what they do cover is a sudden and accidental escape of water. One of the biggest items that we face, a huge challenge in our industry from our side, is this concept of wear and tear. Whether an item burst as a sudden and accidental event, less than a 2-week period, or if it was occurring for a very long period of time and may not be covered by the policy at all. That's a big challenge we face, especially when pipes are hidden in walls and someone's not always necessarily looking at what's occurring. And another area where things can get a little tricky is if there is actual arson that was done at the property. Arson can sometimes change the nature of the policy, at least for the person who committed the arson. So understanding the true nature of the loss, where it comes from, can be crucial. Just because there are certain pitfalls within the policy, it doesn't cover every peril.
That's a great point. Jesse, how do you approach, because it's talking about the sort of seepage exclusion that most property policies contain. I believe the standard language is subject to 14 days. How do you address that from your perspective if there's been a loss that's obviously gone on that long or longer, but was invisible to naked observation until until you couldn't miss it anymore? How do you approach a situation like that?
So one of the very important things is to recognize what you are an expert in and what you aren't an expert in. I know insurance policies and I know how to negotiate with insurance companies. I am not a plumber. So when I have something of that nature come up, I will always have a plumber that is trusted, either someone who's worked with the HOA in the past or someone I work with, who can tell me in looking at the break, is it rounded? Is it worn down? Does it look like water's been coming out for a long period of time? Or is it sharp, very angular? It looks like it could have burst all at once. Sometimes that's enough. A plumber's educated opinion to tell the insurance company, yes, this is a sudden event. It does not appear it was happening long term. For other properties, sometimes we will get granular DWP water usage to show that there was a spike at a specific period. It doesn't always work well for large buildings where you can't account for variances. The last scenario that we have, and it's a duty that the insurance company has too, is to perform a failure analysis test. There are laboratories that will take these broken pieces, run the same pressure as is recorded in the building through the pieces, and see over a period of time how much water is released. And that can help them to know what was the nature of the release. It's not a perfect science, and it's not done on every claim, but that is one way to break it down.
Wow. I had no idea that level of analysis was available.
Interesting. Nor did I. And that kind of leads us into, talking about water damage and some of the exclusions that the policy might have for, leaks over time. We always recommend that boards adopt a water damage intrusion policy that lets the unit owners know what they'll be expected of if the claim is denied by the master policy, so they know their expectations, as well as maintaining a higher deductible so you can shift some of those water damage claims back onto the HO6 carrier or the individual unit owner carrier. Moving into the next section, Jesse, I know that you've been involved in many of the claims from the Southern California wildfires this past year. Have you been involved in any of the claims with the FAIR Plan?
Yes. Many claims with the California FAIR Plan. There's two types of victims right now with these wildfires. There are people that lost their structures in its entirety. The structure's been debris removed at this point, either by a private contractor or the Army Corps. That's one group. The other group are people that only experienced smoke damage. Maybe they had a partial fire or something along those lines, but the majority of what they experienced was smoke intrusion through their property. Starting with the first group, the ones that are total loss, they do get pretty similar treatment to the rest of the claimants out there with other insurance companies. The only thing, as I understand, that the California FAIR Plan will hold back in these scenarios is your code upgrade coverage until it's actually performed and recorded. But they will provide extended replacement costs above the base policy limit, which many of the other insurance companies don't do until you actually build or replace.
So I'm sorry, are you saying that they're paying out more than their policy limits? They'll pay whatever is required, or do they have a set percentage?
Yeah, set percentage. Normally with the California FAIR Plan, it's a dollar amount that's listed as a set extended replacement cost above the general policy limit. And it depends on how the policy is factored. If you've reached the maximums of what the policies will allow, then they gave you the maximum already. Much of the issue that we're seeing, at least with the homeowners associations we've talked to with California FAIR Plan, is that they just don't have enough coverage to actually build the way that the property was, which may lead to large assessments for unit owners. It kind of remains to be seen. But that's a big issue we've seen is it's just not enough coverage.
And excluding the smoke damage.
Yes, so the smoke damage is a totally different animal. For some reason, the California Fair Plan has decided that they're the only insurance company in the state that does not owe for interior smoke damage. In their mind, if the damage can be cleaned, wiped away, then it's not claimable, even though all of the other companies are paying for professional cleaning companies to come in, clean properties, and clean contents items.
What was the verbiage they used? Permanent, sudden and permanent damage, something along those lines?
Exactly. It's like impermanent damage. And it's been challenged in court. They've lost on an individual basis, but their current position is that it was only that one claimant that was entitled to get paid for the smoke damage. All of the rest of them, for some reason, do not apply.
Huh. My understanding is that it's on appeal. Is that correct?
Yes.
And I guess that leads us into the next session. You were mentioning that the main problem you've been seeing is that insureds don't have enough policy limits to rebuild. So touching on property limits, before the wildfires, most carriers were insuring for, $200 a square foot. If you tried to get a policy limit reflecting $400 a square foot, underwriters would think you were crazy unless they worked for affiliated FM, who required something around there. But most experts now are expecting demand surge to drive the cost per square foot up significantly. I've heard things as high as $800 a square foot. What are you seeing in your talks, in your conversations with the carriers and with maybe some of the contractors? Any idea where that's headed?
There's a very big variance amongst all of the subcontractors that we're talking to, which is where the generals are getting their numbers from. I sat in on an informal building alliance meeting with around 6 or 7 builders in the Palisades that we were really there to talk about our issues with State Farm and how for State Farm, they're pricing homes for homes, $280 a square foot to $500 a square foot, which is not realistic for luxury building. There is a very big variance. I've seen numbers go up to $1,500, $1,600 per square foot for ultra luxury. It's very difficult. Part of me wonders if the general contractors are just receiving, outrageous bids from their subcontractors, but that can't be the entirety of the story.
And we should point out that obviously in a condo association with economy of scale, the cost per square foot will be significantly less than a one-off single family home.
Correct. Yes, just because you're doing so much more.
Yeah, it's so tough right now for associations to try to figure out how much they should have in coverage because nobody knows once this demand surge, which is the sudden unexpected demand on the goods and services, really kicks in, because we haven't seen reconstruction really starting yet. They're still clearing debris, as far as I'm aware, and the process for permitting is taking longer than usual. Is that your understanding as well?
Yeah. So as I've seen, I was in the Palisades earlier today. There are homes that are coming up, but no large commercial structures as I've seen so far.
Tony, anything to add on that?
No, I'm just curious, when you talk about the difference between the insured value, prior to the loss on the policy limits and those things, and the demand surge creating such a difference in the reconstruction costs, what are the insured's options at that point? Because obviously they couldn't conceive a policy limit like that prior to the damage. So what do they do at that point?
It is a very, very difficult question that probably has different answers depending on the scenario that you're in. I've seen some people taking loans to bridge the divide and get where they need to be. I've seen others deciding to go back with smaller properties. So everyone has a decision to make here. The shame is that most people are just underinsured.
Have you seen any associations voting to disband, community associations voting not to rebuild and just dissolve the association?
I have not seen that yet, but I have seen some talk of such substantial assessments that the feasibility of actually doing it, at least in my mind, is questionable.
Can you break down, Jesse, the difference between replacement cost and extended replacement cost And how should associations evaluate whether they have enough coverage? Is there a way to do that in the current environment?
So on most policies, and some policies can be manuscripted differently. So it's not a one size fits all. But generally speaking, you have a base limit that applies to the general structure that's on site. Once the insurance company agrees that your cost for restoration exceeds that base limit, you have another pool of coverage, the extended replacement cost, that can be accessed if the damages reach into that pool. Every carrier has a different protocol on when they will issue the extended replacement cost. Some in their policies, it's only due to the insured when building actually occurs or replacement of some form occurs. So it is a very policy specific thing, but that extended replacement cost is what was intended to account for limits potentially being too low. In a catastrophic situation, you were supposed to have this other bucket available to help you recover. The real issue is just that both of the buckets combined are just not enough.
And I guess we get a lot of questions, Tony, so maybe you can speak to this now. There's been a lot of confusion from owners as far as why is the carrier withholding a certain amount of money that we need and giving us actual cash value when we had a replacement cost policy. Can you touch on that?
I was just going to say there's sometimes a difference between the extended replacement cost you're talking about versus a replacement cost up front. Extended replacement cost means that, yeah, at the end of the day, you can recover your depreciation, but you have to spend the money to get to that point. And these are pitfalls that are built into the policy to account for the condition that we spoke about before. So having a detailed understanding of your condition allows you to combat the amount of depreciation that's applied.
So I think just for clarity's sake, we're talking about building limits, and the extended replacement cost endorsements that we're talking about are when the carrier says, we'll pay, you got a $10 million policy limit, we'll pay up to 125% extended replacement cost. So that means you got another 25% pool, as you said, of money to help for those inflation costs, the demand surge, or we've seen as high as 150%. There's a few carriers, it's rare now, that offer guaranteed replacement cost, whatever the policy limit is. But the question I'm really getting at is, can you go over the amount that's withheld from the loss payment until they've confirmed that you've actually rebuilt?
Yeah, I mean, yes. Like they can hold it until you go and spend the money. It is recoverable, but you do need to incur the cost in order to recover it. The main thing to dig into, though, is that the only thing that should be depreciated is material. Equipment and labor do not depreciate. And also, not all material depreciates the same way. Wooden framing is replaced far less often than wooden flooring. So understanding how each item is being depreciated and the rationale behind how the carrier has done it is incredibly important. Whenever I see an estimate that has just a blank percent of depreciation or a blanket percent, I know there's something wrong because that's not the way you do it.
Tony, could you speak to that process?
Even before we get to that point, and I mean, I hadn't considered that perspective on it, Jesse. Thank you for that. But I think to come back to what we were talking about earlier, where you're looking at a situation where someone is potentially underinsured, even with their policy limit and their extended replacement cost, what I think a lot of people may not realize is if they don't actually, as you said, incur that cost of rebuilding, they're leaving that extended replacement cost and any depreciation that may be collectible on the table if they decide to walk away. So for a lot of these folks who are looking at situations where they do face an underinsured situation where they're, contemplating their options, it could be potentially a lot of money that they're just walking away from if they choose not to rebuild.
Yeah. Also keep in mind that if they choose not to rebuild, they do still get that actual cash value from the carrier, and the land itself still has a tremendous amount of value. Jesse, when it comes to total loss scenarios, what do insurance carriers want to see in their contractor estimates? Is it, here's our worksheet, fill this out? How does that process work? And what can the association do to set themselves up to succeed?
So every carrier is approaching total loss quantification in a slightly different way. Many of them are using the Exactimate or Estimate, it used to be Symbility software to prepare it, but they're not all creating the same reports. Some will create full project estimates. Others will create evaluations that are a bit less detailed. So it really depends on which carrier you're speaking to as to how they want to move forward. And I would always recommend to anybody that's in this situation is to ask your adjuster, what is it that you need? Because the reality is that the adjuster you're talking to is not normally the one that is actually authorizing the check to be written and signed. It is either someone above them or another layer above them. So if that adjuster is doing a good job, they should know how to convince their boss to pay. They should be able to help with that. But as a general rule of thumb, detail is key. I see so many contractors producing estimates for millions of dollars that are 1 or 2 pages long. It doesn't give the insurance company enough to compare to. They'll receive it and say, it's not apples to apples. We don't know how to compare it to ours or how it really matches up. So the more detail that you can provide, which sometimes contractors are reluctant to do, that's going to be what the insurance company needs because your adjuster needs to sell it to someone above him.
That's a great point because some of the biggest disputes that delay the settlement of these claims are the discrepancies between the insurance company's valuation and the contractor's valuation. Because what a lot of people don't understand is you had mentioned the insurance company software that they use to, come up with these values. That may not be keyed into things like demand surge or availability of contractors that can cause cost fluctuations that insurance companies can, in some cases, adjust for within the limits of the policy, but not unless they can actually see what they're validating. And I think it's important for the insureds to be aware of, if you can't, as you said, provide that detail, your insurance adjuster has nothing to go argue on your behalf, or even a public adjuster as yourself, Jesse, would have nothing to go and say, hey, look, you guys need to take another look at this because there are extra costs, because there's no detail to explain the extra costs.
And that's why for me, when I get into these types of scenarios, I have to instruct the contractor. Normally, the contractor does not love what I'm asking them to do because they're already involved in the job. They've got the work. They're ready to move forward. They've maybe been authorized for something, but I'm coming over to them saying, now's the time to be held accountable. I need to know, how many sticks of framing are you talking about? What's the cubic yards for all this debris removal? We need this type of information because for me, when I go and represent an insurer and start to negotiate on their behalf, I am owning the data that I'm putting forward. If I'm requesting that they pay for 40 cubic yards of debris removal, I need to make sure that that's the reality of what's actually occurring. So for someone like me, I understand the way we get an insured paid is by doing the legwork for the insurance company. So I will always tell a contractor, we need to sit down, we need to break it down, because no matter what they give me, it's not enough.
Do you find a lot of pushback on that? Because I know that, people are set in their jobs. Like if the contracting company has this process in place and you come in and say, well, guys, we need you to break this down and itemize this. Do you find that you get a lot of resistance, or is it something contractors are usually more agreeable to since they know that's how they have to go to get paid?
They tend to become agreeable when they see the level of work that myself and my staff are willing to put into it. It's different than an HOA member coming to the contractor and saying, you didn't do enough here. I need to see more, or this isn't going to work. I'm actually going to him saying, I think you missed this item, this item, this item, and this item. And these ones over here have no description. Let's talk it through. Let's figure it out. So you are correct that a lot of the time they get a little defensive because they have their ways of doing things. And generally they're successful in doing what they do. But I also know what the insurance company needs. And just like I need to make it easy for the insurance adjuster, so too, I need to make it easy for the contractor.
And one of the functions of this whole process is also to protect the association and the insurance carrier from fraud, right? From overpaying a contractor who's saying it's going to cost $1 million when the job really should have cost $750,000, right?
Well, that's a big issue. There are different types of fraud from the insurance company's perspectives. I have a lot of friends that work at State Farm, friends that work at Farmers, and there are issues with leakage. files that just become larger and they can't necessarily explain why. That's not what we want either. People should not be profiting from insurance companies. Otherwise, the whole premise doesn't really work so well. The insurance companies need to survive too. So we need to keep them well so they can take care of us in times of true catastrophe.
With the whole stated purpose of insurance being to make you whole after a loss, not to improve your standing.
Exactly. But that's where a really big issue comes about, is that we all have a difference of opinion on what true indemnification means. The insured sees it a very different way than what the insurance company sees it as. And someone in Beverly Hills doing a repair of some sort with skim-coated walls and everything, uniform, might have a very different expectation of what they're going to receive than someone on the other side of town with a bunch of patches and mismatched whatever. And that's a big issue with the estimating softwares that are put forward, is that the price point for a wood flooring item in Beverly Hills or the Palisade is the same as anywhere else throughout the city of Los Angeles. And that's not realistic.
That makes sense. So I know you mentioned that you've dealt with a lot of these claims from the recent wildfires. Any suggestions for what could have made some of these claims go smoother for the boards?
One thing I would say is it behooves everyone to have a good understanding of your CC&Rs. You need to know what exactly is the unit, what exactly is the common property, so that unit owners and the HOA come into it with a realistic expectation of what they are expected to account for. The other aspect is really just, I would say, having a level of coordination in place where, especially a lot of the communities we're working with now, they see all of the various pitfalls that have come up from the Palisades wildfire, at least, and they will be prepared for the future on how to tackle these things because they've done it now. We need to take all of this information that we're learning now and apply it towards the future. This may not be the last time. And the only other thing that I would say that's important for these communities is having like a pre-contracts in place with some of these mitigation vendors that you can trust, that you know will take care of what needs to get taken care of. When an event like this happens, it is an emergency and a catastrophe, and it is not a small endeavor. You can't pick a random outfit to take care of you. It needs to be someone that is vetted, that knows what they're doing, and that is capable of actually performing. That was a big pitfall that we saw with many communities where they thought they could trust the vendors they were working with, but they had not vetted them appropriately.
I know there are a number of emergency services that are members of CAI, the Community Association Institute. What does a pre-contract look like? It's just, you're our guys. We pay you a monthly fee, an annual fee or something? Or it's just an agreement ahead of time. If something goes wrong, we're reaching out to you.
It could be a variety of those things. I've seen some vendors do it where they will do, let's say, every 3 or 4 months, an inspection of the property. They provide a level of report that would probably account for some of those conditions we were talking about as well. And then should something occur, be it a leak of some sort or a large scale event, they just get notified to come onto the property and to take care of it. So I guess it could have a variety of appearances because you may need them for different things. Some of these restoration vendors are also contractors. They're able to perform repairs, do things along those lines. You may be having them do things that are emergency activities where they need to come immediately, or things that get more scheduled and processed and approved over time. So it really could vary.
And you mentioned, one of the main issues being getting your ducks in a row ahead of time. And so everybody understands clearly who's responsible for which components. To that end, we've seen a number of matrices attached to CC&Rs where it's got the maintenance, repair, and replacement broken out per component. Is that a helpful item?
I would say so, yes. The more detail that can be provided ahead of time, it's going to save time later and answer questions that are going to come up. We just need to make sure the detail's accurate.
Including letting the unit owners know that if there is a loss like a wildfire and their unit is uninhabitable, the association's master policy is not going to pay for them to live somewhere else, unfortunately.
Correct. And it's very important because many of the unit owners that we're coming across don't necessarily have insurance. They have a very difficult path ahead of them, but they need to know what resources they have and what they don't.
Tony, anything else you wanted to add?
No, I just to echo the fact that I think having that plan in place, just like we had mentioned with the water damage loss earlier, I think if you have some sort of protocol and written, instructions and expectations in advance of a wildfire or an event like this, I think Jesse's right. It will cut some of that stress and drama of the uncertainty because you will have an expectation, you will have an understanding of at least what's supposed to happen. Even if things get slightly detoured along the way, as they are wont to do in a situation on that scale, at least you know the sort of framework and the guidelines where everyone's expecting to go.
Jesse, any final thoughts?
No. I really want to thank you guys for taking the time to do this. This is information that is crucial for homeowners associations and unit owners. And the sad reality is that it's just not out there on the internet ready for the taking.
Jesse, where can our listeners go to reach you or learn more about the work that you guys do?
So our website is RubinAdjust.com. That's RUB like boy, INADJUST.com. And if you'd like to reach me personally, my number is 818-935-3521.
And the last thing I'll say is one question. Do you give your kids bedtime stories about claims?
So I don't give my kids bedtime stories about claims, but I did sit down my 5-year-old on the way to school the other day, and I told her, I said, look, I know you have no idea what I do, but just know one day, if you want to work with Papa, you totally can. No, because I'd love to do that. That'd be a blessing to pass it along.
Well, thank you so much. That's our show today. Special thanks to our guests, Jesse Rubin and Tony Minke. As we end our episode, we'd like to remind our listeners that if you have any comments, questions, or suggestions for topics that you'd like to learn about, you can email us at feedback@hoashow.org. Join us next time on The HOA Show.
To share or subscribe to the HOA Show, visit us at hoashow.org. There, you'll be able to listen to other episodes, find helpful resources relating to HOAs, provide feedback, submit questions, and check out other great stuff. The HOA Show podcast has been made possible by the contributions of Klein Agency Insurance Brokers, leaders in the community association industry. The views and opinions expressed by the podcast, its presenters and guests, do not constitute legal advice. For more information on how the topics in discussion apply to you, please consult with your own legal counsel.